My name is Julia Howe. I'm the Vice President of Business Development covering Central Ontario at GlobalX. And I'm joined today by two of my colleagues, Chris McHaney, Head of Investment Management and Strategy at GlobalX, and Vern Roberts, Vice President and Associate Portfolio Manager on the investment team. Without further ado, I'm going to pass things over to Vern to talk about the size and scope of GlobalX Canada and what makes us subject matter experts in the options-based ETF space.
So when you look at GlobalX Canada, you're looking at one of the top ETF providers in the country, and we have over 36 billion in assets. Those are spread across 134 ETFs, which include both benchmark, inverse, and leverage, as well as active funds. Now, when you look at our covered call funds, you'll see we started this business in 2011. But most recently, over the last year, our assets have grown from under 500 million to nearly 2.5 billion in the last year. And our covered call suite includes both sector funds, index funds, as well as fixed income funds that sell both calls and puts.
Thanks, Vern. Chris, the focus of today's webinar is harnessing the volatility in fixed income. Can you talk us through the current state of the fixed income market?
Sure, and I think it's important for investors to understand where we are in the fixed income market now and how that's changed from the last several years and actually is more normalizing now than it was in the past. If we go back just to the financial crisis coming out of 2008, 2009, central banks globally really adopted very accommodative monetary policies. We think about things like zero interest rates, quantitative easing, in fact, even in some places, negative interest rates. That had the effect of really taking volatility completely out of the fixed income market and the rates market overall. Fast forward to today, we've come out of COVID, and again, rates dropped significantly during that COVID lockdown. We've come out of that with inflation. Rates have come up quite a bit and are now stabilizing. And that's really had the effect of bringing volatility structurally back into the fixed income market. And it looks a lot more like it used to, sort of pre-financial crisis. So, when it comes to options and the volatility markets, volatility is key for generating cash flow out of options. And so seeing that volatility come back to the fixed income market makes us think that we can actually, generate some meaningful cash flow out of that asset class. At the same time, when you look at credit spreads on investment grade fixed income, not quite at the multi-decade lows, but near those lows in terms of where those credit spreads are. So for investors that are looking for some sort of income pickup over and above what government bonds give them, the credit spread, the credit market doesn't look very attractive right now. And at the same time, that volatility market and that options market really looks attractive for generating that cash flow.
And what about the interest rate outlook? Can you talk to us a little bit about how short-term rates and long-term rates can affect the trajectory of income or investment strategies?
Yeah, and I think this is another important area for investors to understand that we're at a point now where the drivers of short-term rates are differing from the drivers of long-term rates. In the past, we had that sort of parallel shift in the yield curve. But what we've seen recently, especially since the U.S. Federal Reserve has started cutting their interest rates, in the short end, we've seen about 75 basis points come down. If we go back to sort of end of June, that's the movement we've seen on the short end. But on the long end, when we're looking 10 years and out, those yields, although they kind of went down and came back up, they're at the same place they were essentially at the end of June. So again, we're seeing a bifurcation in the fixed income market. And I don't think investors can just think, okay, rates are going down, therefore I'm going long duration. Because we're not seeing rates move necessarily in the same fashion as we're seeing in the front end. So I think investors just really need to be cognizant of that and, again, determine when they're allocating fixed income, which part of that yield curve they want and what rates they want exposure to.
I think that sets the stage for why investors would want to consider products that have different durations and also can monetize some of this volatility in fixed income. Vern, GlobalX recently launched a suite of enhanced yield treasury ETFs. Can you talk to us about these products and what makes them unique in the Canadian market?
Sure. To echo Chris's point, the yield curve is behaving differently on the short side than on the long side. What we've done what we did a year ago is we launched 3 products for the US market, for that give you exposure to US rates, if you will. We offered a short duration product, mid duration product, and a long duration product, tickers SPay, MPay, and LPay. And most recently, we launched Canadian government's products with tickers PayS, PayM, and PayL, which you can see on the chart. Now, if we go to an overview of the US underlyings, SPay, MPay, and LPay, what you'll see is a product line that covers the yield curve from short duration to long duration. Our short duration product, SPay, the portfolio is a mix of long bonds and T-bills. Specifically, it's about 10% long bonds, 90% T-bills. Our mid-duration product is about 40% long bonds, 60% T-bills. Then our long duration product, again, is majority long bonds at 80% with about 20% T-bills. And if you look at the options program on the next slide, you'll see that unlike covered call funds, these premium yield funds allow us to sell both calls and puts. And upon launch initially, we launched the short duration product selling 10% calls, 10% puts. The mid duration product selling 15% calls, 15% puts. And the long duration selling 20% calls, 20% puts. So I'd say that's the main structural difference between our premium yield series and your traditional covered call ETF. And now if we look at the next slide, I'll give you an overview of the Canadian products that we've launched, most recently the mid and long duration. But again, you can see a similar structure to the US products where the short duration product is 10% US long bond, 90% Canadian T-bill. And then again, mid duration is about 20% US long bond, the balance bills and bonds from Canada. And then the long duration product is 30% US long bond, 70% bills and bonds from Canada. And what differentiates this Canadian series from the initial US series of SPay, MPay, and LPay is that the Canadian series is hedged back to the Canadian dollar, so there's no FX exposure. And finally, if you go to the next slide, you'll see the option overlay program is very similar to the US product, selling both calls and puts, ranging from 10% calls, 10% puts on the short duration to 20 and 20 for the long duration.
So Chris, now that we know about all 6 products in this suite, both Canadian and US, and then short, mid, and long duration, can you talk about the ideal investor for these products based on risk tolerance and income objectives?
Yeah, and you can really see, again, with 6 different solutions there, probably a solution for every type of investor or many types of investors. And I think really, of course, the first element is income. So if you're an income-oriented investor, this is something you might want to look at because the emphasis is on generating cash flow, not just from the underlying fixed income instruments, but from the option overlay on top of that as well. So again, that income-focused investor is really the first step you should be looking at here. And then, you really need to determine, what income level do I need and how much volatility am I willing to accept to get that? Vern mentioned how on the long duration solutions like LPay and PayL, the amount of option overlay is kind of 20% calls, 20% puts. So more option activity on the long duration than on SPay or PayS, for example. So higher cash flow potential from those long duration products, but more volatility from the underlying investment as well as, those bonds will move around with interest rate changes and with that duration exposure. So again, investors willing to accept a little more of that day-to-day volatility for that higher level of income maybe want to tilt towards that longer exposure, and those that want a more safe, steady as she goes type of investment maybe want to tilt towards the short end, either SPay or PayS.
Could you also speak to us about how some of these products would complement an equity-focused portfolio?
Yeah, and I think, at the core, these investments are invested in Government of Canada or U.S. Treasury securities, right? And so they are government bonds and act like government bonds for the most part. We talk a little bit about how that option overlay not just generates income, but also dampens volatility a little bit. So you're not getting the, call it, full exposure of a long bond, just plain vanilla versus LPay, for example. But generally, Government of Canada and Government of US securities will increase in value in a risk-off type of environment. So when equities are selling off broadly, you would expect some lift from the fixed income portfolio. Again, I think investors here just need to keep in mind, in exchange for a lot of that income we're generating, you might not get as much protection as just that pure bond portfolio. But again, being based on government securities, you're going to get that slight flight to safety trade when there's a risk-off type environment.
Vernon, turning to the mechanics of these portfolios, can you talk to us a bit about how the option strategy works?
Sure. So if you're looking at the slide, what you'll see is a transition from equal weight calls and puts to a skew towards puts. And the environment that sets this up is, as rates are falling and bond prices start to increase, the typical criticism we get for covered calls is that you're always selling away your upside. Now, the strategic advantage we have with these products is we do not have to sell calls. We don't have to sell equal calls or puts. These are all active products. And what we can do is we can skew towards selling more puts than calls, in essence, selling away the downside in an environment when bond prices are going up. If you look at the next slide, you'll see the implications of this, where let's say we start on this red line on the right side of the chart. As we skew towards selling more puts, this profit chart gets a bit steeper, where we participate more in the upside and more in the downside. Now, you could argue this risk is not symmetrical in a rate falling environment. We'd like to participate more in the upside as bond prices are going up. And this is what we can do with these products.
So you started to allude to this, but can you talk to us about a scenario where you would skew one way or the other between calls and puts, since this is such a unique factor to our enhanced treasury products versus some of the competitors?
So I'll draw everyone's attention to near the end of 2023 last year, where there was a lot of uncertainty whether the Fed was going to raise rates or bring rates down. And in that November meeting, Chairman Powell alluded to the fact that rates are not going up anymore and that they may fall. And if you looked at the forecast for rates after that meeting, there was a bit of euphoria where everyone thought we were going to get 5 cuts in 2024. And then it became this massive risk-on trade where stocks went up and the long bond, particularly TLT, went from 89 to 101 by the end of the year. And when you look at this chart, what you'll see is the difference between our pay series long duration product and another similar fixed income covered call product that is not able to sell puts. And because they weren't able to sell puts, I'm pointing to the little blue line that's the shorter line at the bottom and not as good as the other line, is during this run up, as you have to sell calls, you can't participate in bond prices going up versus us who can sell less calls, sell more puts. And as the price goes up, we can participate more in that upside. If you go to the next slide and you'll look at the performance table, you'll see this as extended, whether we're going back a year from now or even year to date. You can see the performance delta between an ETF that can sell calls and puts versus one that can just sell calls.
Very interesting. So Chris, turning to you, what kind of risk return trade-off can investors expect if they are looking to add these products to a portfolio?
Yeah, I think if we pull up the performance of the pay series, these are the funds that have been launched for over a year now. We have more than a year of track record here. You can see what the live performance looks like, and you can really see how it's differentiated from SPay, very low duration and low risk type of solution, all the way up to LPay, which is very duration differentiated and therefore has different risk return characteristics to it, right? If we start at the left hand of this chart, that period Vern was alluding to where, 10-year yields were going down significantly, you see the rise in that long duration solution really giving a nice upside participation, whereas that shorter duration fund also positive, but just much less so. And again, the reason for that is when you see rates going the other way and things coming back down, it's a nice, much smoother ride on the short duration solution. So I think, again, for investors looking for that nice risk return trade-off, you think of high income, low volatility, that's that SPay, and that's really in the short duration bucket, all the way up to LPay, which is not just income, but also growth potential, or again, that risk off element versus equities that the LPay is giving you as well. So different environments will have different solutions or different return characteristics, but I think this chart really illustrates well the duration differentiated solutions that we have for investors to choose from.
Well, I've done a lot of talking and asked a lot of questions. At this point, I would like to open it up to the audience for questions. At this point, I will remind everyone there is a question box. If you have anything to ask Chris or Vernon, please do so now. I will read things out as they come in. So some of the questions that we are receiving, how are these distributions expected to be taxed?
So there's going to be a mix in that taxation. Of course, from the underlying investments, you're going to generate income from those fixed income investments. And the option premium cash flow should be taxed as capital gains. So you'll get a nice tax efficient income from that option pickup. And again, there will be some interest in there as well from the underlying investments themselves.
This question is probably for Vernon. We were asked, what was the reason for adding U.S. Treasury bonds to the Canadian Treasury suite?
That's a good question. I would say if you look at how we're generating the additional income for these products, we're selling options, and the TLT options that we've chose are the most liquid and deepest of the option markets for fixed income. And add to that the vol that's priced into these, we're able to manage our exposure and generate an income in a way that we couldn't do with any other option on fixed income.
Another question here. We talked about credit spreads. Was that spread between the 10-year or was that looking at something else?
So that chart we used was a generic 5-year spread. So that's sort of a constant 5-year maturity on corporate bonds relative to an equivalent government bond. So kind of the most common credit spread used. That was on U.S. corporates as well, just to clarify, not on the Canadian market, but you see similar dynamics in Canada as well.
We've seen HISA and GIC rates dropping quite a bit over the past few months. Is one of these products a suitable replacement for a cash-like holding? And if so, which one would you suggest?
Yeah, I mean, personally, I would look to PayS myself. That's the Canadian underlying solution, and that's the short duration product. Again, when we're looking at the performance charts here and we look at these lines, you can see the one that is most similar to that sort of short-term cash-like solution. This is SPay in US dollars, just to give that full 1-year history. But PayS going forward should act very similar and doesn't have currency exposure. Of course, if investors had US dollars and wanted that solution, you can go to the established SPay or SPay.U as well.
That does answer another question that we just had come in. We were asked about how foreign exchange affects the performance of these products. Anything else you want to add there?
I can touch on that one. If you look at with the US SPay, MPay, and LPay versus SPay.U, MPay.U, LPay.U, the .Us are US assets in US dollars, whereas the non.Us are US assets in CAD dollars. They are exposed to US rates.
And we had a question about if there are particular accounts that these should be held in, whether that's registered or non-registered.
Yeah, I guess for me, again, going back to the tax efficiency of those cash flows, particularly on the option overlay piece, there's a argument could be made these could be held in taxable accounts, but again, there is a mix of interest income in there as well. So I'll say, the cash flows are somewhat tax efficient to be held outside of a registered account, but of course can also be any registered account that needs that cash flow coming out of it.
And I don't think this was addressed on any of the slides. What are the fees of these ETFs?
Now you're going to test my memory. I believe for SPay, MPay, and LPay, there are 35, 40, and 45 basis points. And for the Canadian hedge version, they are 40, 45, and 50 basis points. Sounds right.
That sounds right.
Yeah.
Another question here. In comparing HYPT and LPay, there is a large spread in distribution yield. Is LPay at the maximum yield, or would you expect this distribution to change at any point?
Well, what I would say is the way we approach our distributions is to look at the underlying asset class, the underlying strategy that we're managing, and try to determine over the long term, over sort of a business cycle, what income can we expect to generate out of this sort of strategy. And that's really where we want to set our distribution rates at, is over the long term. Some months we may generate more than that. Some months we may generate a little bit less than that, but over the long term and on average, we want to set our distribution rates to the income that we're generating. Of course, we do review this every sort of quarter or so to make sure these rates are still applicable. And so to the extent we think we could distribute more, we would increase that distribution. But if we think structurally, maybe something's changed in the market and we're not going to be able to earn that yield anymore, we would reduce it. But at the same time, we want to keep it consistent and predictable for investors that are depending on that sort of regular income.
Picking on some of our competitors who may be distributing more than they are earning, what is the harm in doing that?
Well, in essence, if you're distributing more than you're earning, then that's got to come from somewhere, right? And so that's going to lead to what we call NAV grind, or the NAV or price of that ETF kind of trending down over time, all else being equal. Really what you want to see is that distribution matching what you're earning, then the price would stay stable, again, all else being equal, and then the price obviously would move based on the underlying market dynamics of interest rates.
Okay, I think we are through most of the questions here. Chris, Vernon, I'd like to quickly say any final points before we wrap today's webinar up.
Yeah, just happy to review this suite overall. We think it's a very innovative suite and kind of unique in Canada, and so that's one of the reasons we wanted to highlight it today. As well, with 6 different solutions, we think there's something for pretty much all investors there.
Vernon, anything to add there?
I don't think I could say it much better than that. I would say, if you have US dollar assets, having US assets in US dollars takes the FX exposure away from you. If you have Canadian dollar assets, I would say the same. Having majority Canadian assets hedged to the Canadian dollar. If you don't want to take foreign exchange exposure, focus on the Canadian suite would be the ideal approach.
All right, well, thank you all for your time today. As a reminder, we are social. Please do connect with us. And for any questions, there is a general line, or for investment advisors, please reach out to your respective sales teams. Thank you again and have a great afternoon.